Times are tough for investors trying to offload units and apartments here in Melbourne. As Chris Kohler discovered, 1 in 5 is now selling at a loss.
We have an asset worth $1.5 million that right now is worth nothing.
If your property is now worth less than the mortgage that you've got and you sell the property, you still owe the bank.
More than 50,000 first home buyers are at risk of losing money after house prices tumble in some capital cities.
I was looking for 1.9.
Right. And did you get any bids?
Not one.
If you own an apartment in Australia right now, I need you to hear this. In the city of Melbourne, nearly half of all apartment resales, 45.9%, sold at a loss in the September quarter of 2025. The median loss was $64,500, and that's just the paper loss. It doesn't include the stamp duty you paid when you bought, the owner's corporation fees you've been paying every quarter, or the years of your life spent holding an asset that went backwards. In this video, I'm going to take you through 10 Australian areas where apartment owners are losing money on almost every sale, what's actually driving it, and what it means if you own one right now.
So Cotality's new pain and gain report has revealed some pretty tough results for Melbourne apartment sellers. What's the story there?
Yeah, it's not the rule of values doubling in 10 years for everyone. In fact, Melbourne City Council area has posted the highest proportion of loss-making sales for units in the country. On average, owners who held a unit for the last 10 years lost around $65,000.
Right. Let's walk through the worst hit areas, starting with Melbourne. Because Melbourne dominates this list like no other city in the country. Cotality data shows Melbourne's unit market accounts for 29.1% of all loss-making resales nationally. Nearly a third of every apartment loss in Australia happens in one city, the City of Melbourne LGA. The CBD Docklands South Bank is ground zero, 45.9% of resales at a loss. Yahoo Finance reported that the average holding period for these loss-making sales was 10.9 years. Let that land. People held for a decade and still lost money. One apartment owner on Reddit put it plainly. They'd lost $55,000 on a one-bedroom Melbourne apartment and were asking whether to cut their losses and sell or keep holding and hope. Their calculation, selling now would likely result in a loss of about $55K. I estimate my rental expenses over the next decade could total around $215K. Either way, they lose. That's the trap. Surrounding Melbourne's CBD, the numbers are almost as bad. Domain reported South Yarra at 41.9% of unit sales at a loss. Stonington, which includes Prahran and Windsor, at 29.8%. Port Phillip at 26.3%. Yarra at 23%. Boroondara, suburbs like Hawthorn and Camberwell, at 22%. These aren't fringe suburbs. These are some of Melbourne's most established inner-city areas.
That how the housing market is going to see some cooling. We've already seen that even before the announcements at the budget, that interest rate rises, the 3 interest rate rises we've gotten from the RBA over the 3 consecutive meetings, that have already been starting to slow down the housing market. We're seeing declines in house prices in Sydney and in Melbourne.
And the individual stories are devastating. One commenter on Oz Property Chat described a friend who lost $280,000 over 8 years on an off-the-plan Docklands apartment. Their exact words: "This amount doesn't even take into account additional expenses incurred during that time, such as body corporate fees, land tax, and rates. It's truly a disheartening investment." Another replied, "Bought off-plan in 2016, moved in 2018, and negative growth over one of the biggest housing booms." And then there's Docklands specifically. 50% of all Docklands apartment sales are at a loss. Over the last 10 years, apartment values in Docklands have gone down by 11%. Not up, not flat, down, while the rest of Melbourne's housing market surged. 65% of Docklands stock is investor-owned. The investors who bought to make money are the ones losing it.
The biggest kick in the teeth is that portion of units sold at a loss in Docklands, 50%. But the biggest loss is what they actually missed out on, which is about $1.5 million. So hypothetically, they spent $1,685 on the Gold Coast.
But here's what makes this crisis different from a normal market dip. Charter Keck Kramer, one of Australia's leading property research firms, Published data showing there are 8,000 completed apartments sitting unsold across metropolitan Melbourne. 8,000. That's 17% of all units completed between 2020 and 2024. And here's the kicker. Existing apartments sell for $8,000 to $10,000 per square metre. New apartments need to sell for $12,500 to $15,000 per square metre, just to cover delivery costs. Richard Temlett from Charter Keck Kramer said it directly. Developers can't launch new projects when there's competing stock at a 50% discount down the road. So old stock can't sell at a profit, and new stock can't sell at all. And this isn't just Melbourne. Sydney's apartment markets are bleeding too, just more quietly. Domain data shows Parramatta at 24.1% of sales at a loss, with a median loss of $50,000. Strathfield at 22.3%, Ryde at 22%. One buyer inspecting apartments in Mascot and Epping posted on Reddit, "All the units I inspected, the owner lost around $100,000 to $200,000. That's not one bad deal. That's a pattern across entire suburbs." Darwin had the highest citywide loss rate in Australia at 17.2%, though Cotality noted it was the most improved market, meaning losses are at least shrinking there. Hobart's loss rate jumped to 5.7%, the biggest annual increase of any capital.
Tact. A patient buyer purchasing a character home in West Hobart or Sandy Bay today is likely to look smart in 10 years. For outer estate property, the answer is no, not yet. The downward trend in these areas hasn't run its course.
And one story captures the human toll better than any chart. An apartment owner on Orse Property Chat described listing their apartment on Airbnb after it sat on the market for a full year unsold. They'd taken out a bridging loan to buy their next place, assuming the apartment would sell. It didn't. When it finally did, their exact words. The bridging loan offer only just managed to cover the bridge loan, leaving us with a mere $1K surplus. A year of stress, Airbnb desperation, and a $1,000 surplus at the end of it. To be fair, the national picture isn't uniformly bad. Cotality's Q1 2025 data showed 94.9% of all Australian property sellers made a profit. Perth and Brisbane's apartment markets remain strong. Adelaide's loss rate is under 1%, but the losses are concentrated, and they're concentrated in the two cities where most Australians live, Melbourne and Sydney, and units account for 68.9% of all loss-making sales nationally. Houses aren't the problem, apartments are. And here's why this matters beyond Australia. New Zealand's apartment markets corrected first, and the numbers are a warning. Wellington is down 25% from its post-COVID peak. Auckland is down 22%. The National New Zealand Index fell 18% from peak, and Cotality NZ's pain and gain data shows 9.2% of all New Zealand resales were at a loss, nearly double Australia's national rate. New Zealand isn't a different story. It's the same story 3 years ahead. So why are apartments specifically the ones losing money? 3 reasons. Oversupply, 8,000 unsold in Melbourne alone. Quality, the NSBU Building Commissioner confirmed on ABC 7:30 that 53% of apartments registered since 2016 have at least one serious defect. And costs, owners' corporation fees, cladding remediation levies, and now increased land taxes are eating into any value apartments might otherwise hold.
He was appointed in 2019 and has been trying to stamp out bad practice ever since. But it's an enormous task. A state government strata survey in December revealed 53% of apartments registered since 2016 have at least one serious defect.
The Reddit community sees it clearly. In a thread with 185 upvotes asking, why are there so many apartments for sale in Melbourne under 500k? The top comment, 226 votes, said, the government has reduced incentives for property investment in Victoria, leading to over 5,000 unsold apartments. Numerous property owners are experiencing negative equity. Another commenter with 62 votes. There is an abundance of poorly constructed apartments with high ongoing costs, significant owners' corporation fees or hefty levies due to cladding issues. And perhaps the most honest post came from an owner who finally sold at a loss and felt nothing but relief. Their words, after years of distress and a significantly diminished quality of life, I finally managed to sell the place, but at a loss, naturally. The top reply, Melbourne apartments are notorious for major losses. To be fair, Cribber is forecasting a cumulative deficit of 75,000 apartments through to 2029. The demand for well-located, well-built apartments hasn't disappeared. It's the poorly built, oversupplied stock, concentrated in Melbourne's CBD, Southbank and Docklands, that's dragging the numbers down. If you own a quality apartment in a low-supply area, this data doesn't necessarily apply to you. But if you bought off the plan in a tower with 300 units in Docklands, the maths doesn't maths, mate. If you own a Melbourne apartment in the CBD, Southbank, Docklands, or South Yarra, the Cotality data says your chance of selling at a loss is between 40 and 50%. If you're in Sydney's Parramatta, Strathfield, or Ryde, the loss rate is above 20% and rising. If you bought off the plan in the last 5 years, the Charter Keck Kramer data says new stock needs to sell for 50% more than existing stock just to break even on delivery costs, and nobody's paying that premium. If you're thinking about buying an apartment, look at the defect rate, look at the owner's corporation fees, and look at how many unsold units are sitting in the same building. The data is there. Here's the truth. Nearly half of apartment sellers in Melbourne's CBD are losing money. Sydney's western suburbs are following. 8,000 apartments sit unsold across Melbourne. And New Zealand's markets, 3 years ahead of ours, show what happens when this correction runs its full course. I'll be covering the Cotality data every quarter, the suburb-level breakdowns, and every shift in the apartment market as it happens. Subscribe to the MOSIN report so you don't miss the next video. Thanks for watching. See you in the next one.